Are you ready for a shocking prediction for the gold market? Jim Rickards, a world-renowned economist and author, has made a bold statement that will have significant implications for investors. Jim is a former Wall Street lawyer turned portfolio manager, government advisor, lecturer, and best-selling author. With his vast expertise and deep understanding of the gold market, Jim Rickards has earned a reputation as one of the most respected voices in the industry. As the global economy grapples with downward pressure and the looming threat of deflation, Rickards' insights offer a unique perspective on how gold may fare in these uncertain times. His prediction has the potential to reshape our understanding of the role of gold as a safe haven during deflationary periods. In this video, we'll explore Jim Rickards' latest prediction regarding the gold market. The nightmare of deflation for central bankers. Deflation, often regarded as the opposite of inflation, refers to the sustained decrease in the general price level of goods and services. While it may sound like a desirable scenario where prices fall, the consequences of deflation can be severe. Deflation leads to reduced consumer spending as individuals postpone purchases in anticipation of even lower prices. This drop in demand negatively affects businesses, resulting in layoffs, reduced payments, and a slowdown in economic growth. In addition, deflation increases the real value of debt, making it more difficult for borrowers to repay their obligations. During deflationary periods, holding cash can prove to be a valuable asset. As prices decline, the purchasing power of currency increases, allowing cash holders to acquire goods and assets at lower prices. The flexibility and increased purchasing power can be advantageous when the economy experiences deflationary pressures. Cash also provides a sense of security and liquidity, acting as a buffer against potential financial shocks. However, it's important to note that while cash may be beneficial during inflation, alternative investment strategies like gold can also play a crucial role in protecting wealth. Deflation is a central banker's worst nightmare. When faced with deflationary pressures, central banks often find themselves in a difficult position. Traditional monetary tools such as interest rate cuts become less effective as rates approach zero or enter negative territory. Central bankers are forced to employ unconventional measures like quantitative easing and asset purchases to stimulate demand and counter the threat of deflation. However, these measures come with their own set of risks and potential unintended consequences. One notable example of a country averse to deflation is the United States, known as the world's biggest debtor. The U.S. economy relies heavily on borrowing, and deflation increases the real burden of its massive debt. A deflationary environment can lead to decreased consumer spending, reduced business investments, and increased debt defaults, all of which could have severe consequences for the U.S. economy. As a result, the Federal Reserve, the country's central bank, closely monitors and takes measures to prevent deflationary pressures from taking hold. Central banks' limited tools in deflationary environments. When faced with deflationary environments, central banks often turn to quantitative easing as a tool to stimulate economic growth. However, QE has its limitations and can be ineffective in combating deflation. QE involves the central bank purchasing government bonds and other securities to inject money into the economy. The goal is to increase lending, stimulate spending, and encourage inflation. However, in deflationary periods, consumers and businesses tend to be cautious with their spending, regardless of the ability and availability of cheap credit. This lack of demand makes it challenging for QE to have the desired effect of increasing inflation and combating deflation. Another tool at the disposal of central banks is adjusting interest rates. Lowering interest rates can encourage borrowing and spending, thereby boosting economic activity. However, in deflationary times, central banks face challenges in using, interest rates effectively. When interest rates are already near zero or in negative territory, as we have seen in recent years, central banks have limited room to further lower rates. This reduces their ability to stimulate borrowing and spending, hindering their efforts to combat deflation. Moving on to Wall Street, the financial hub that closely watches the actions of central banks, particularly the Federal Reserve. Wall Street's perception of the Fed's actions during deflationary times is crucial. If they believe the central bank's policies are ineffective or inadequate in fighting deflation, it can create uncertainty and volatility in the markets. Investor confidence can take a hit, leading to potential consequences such as decreased investment, reduce economic activity, and heighten market instability. Let's not underestimate the severity of the economic damage caused by deflation. When prices start falling, people tend to postpone purchases, expecting prices to drop further. This decline in consumer spending directly affects businesses, leading to lower revenues and profitability. It's a ripple effect that can result in job losses, wage cuts, and an overall slowdown in economic activity. Moreover, deflation increases the real value of debt, making it harder for borrowers to repay what they owe, creating a burden on individuals, businesses, and governments alike. Historical expenses and lessons. When we think of severe deflation, one of the most important and significant examples of severe deflation in history is the Great Depression. During this time period, in the 1930s, the global economy faced a massive downturn, leading to widespread unemployment, business failures, and a sharp decline in prices. The deflationary spiral worsened the economic crisis as consumers and businesses held onto their cash, causing a further decrease in spending and economic activity. In response to the Great Depression, President Franklin D. Roosevelt took bold actions to break the back of deflation and promote economic growth. His New Deal policies aimed to stimulate the economy through government spending and job creation. Roosevelt's approach included infrastructure projects, social welfare programs, and regulations to stabilize the financial sector. These measures helped restore confidence, reignite economic activity, and eventually put an end to the deflationary pressures. Enjoying this video? Give it a thumbs up and share it with your loved ones. Don't forget to subscribe and hit that notification bell to stay updated with our latest content. Now let's jump back in. An important lesson we can learn from history is the role of devaluing the currency against gold and reversing deflation. In the past, such as during the Great Depression, governments devalued their currencies against gold as a means to encourage inflation and economic recovery. By reducing the value of the dollar in relation to gold, it made U.S. exports more competitive and stimulated domestic production, leading to increased economic activity and higher prices. This devaluation strategy proved instrumental in breaking the cycle of deflation and jump-starting economic growth. It's important to note that the current economic system lacks a gold standard. In the past, the value of currencies was tied to gold, providing a form of stability and a reference point for monetary policy. However, since the abandonment of the gold standard, central banks have had more flexibility in managing their currencies and implementing monetary policy. While this has provided greater maneuverability, it has also brought about new challenges and uncertainties. Looking at historical examples, such as the Great Depression and the actions taken by leaders like FDR, we can see that addressing deflation requires bold measures and innovative policies. Protecting yourself as an investor. With economic uncertainties looming, it's crucial to explore strategies that can safeguard our wealth, and according to the renowned expert Jim Rickards, gold shines as a hedge against deflation. Jim Rickards has consistently emphasized gold as a valuable asset to protect investments during deflationary periods. Gold possesses unique qualities that make it an attractive option. Unlike paper currencies that can be susceptible to devaluation during deflation, gold holds its intrinsic value. Its scarcity and time-tested allure have made it a trusted store of wealth for centuries. When we examine the long-term performance of gold, we find that it has demonstrated its resilience during inflationary periods. In times of rising prices and eroding purchasing power, gold has consistently held its value and even outperformed many other investors. When it comes to long-term performance, gold has demonstrated its ability to generate solid returns. Looking at historical data from January 1971 to December 2022, gold has recorded average annual returns of 7.78%. This performance places gold just slightly behind commodities, which boasted average annual returns of 8.3% during the same period. These figures indicate that gold has been a reliable investment option, delivering consistent returns over the years. As we narrow our focus to the more recent past, let's examine the annual average return of gold in 2022. Despite the challenges and uncertainties faced during that year, gold has still managed to provide a positive return. With an annual average return of 0.4% in 2022, gold demonstrated its resilience in the face of market fluctuations. This performance underscores its role as a potential safeguard for investors, even during periods of relatively low returns. In an uncertain economic climate where inflationary or deflationary pressures may arise, gold can act as a reliable hedge, helping to preserve wealth and provide stability. Its track record as a store of value makes it an attractive option for investors seeking to protect their investments. By diversifying portfolios and allocating a portion to gold, investors can potentially mitigate the risks associated with deflation and navigate uncertain economic waters with greater confidence. If you enjoyed this video, guys, make sure to subscribe to the channel, like this video, and watch this one as well.